it's probably very risky to be overexposed with capital in the bank. I mean, we just had a board member of the FDIC in an online meeting literally say that there could potentially be bail-ins. And this is the institution or the entity that insures deposits of depositors and banks for up to $250,000. And they're telling you that there will be bail-ins. So people say, well, where else do I keep my capital? And this is where infinite banking comes in. This is a great vehicle to position cash in, because the companies have been around since the mid 1800s. They've gone through depressions, market crashes, recessions. They've gone through monetary resets. Monetary resets is a big topic that a lot of people are talking about in the investment world. Well, these mutual insurance companies have lived through several of these monetary resets. It's also essentially out of the Wall Street casino because it's a mutual insurance company. These companies are not listed on the stock exchanges, and they don't have to participate in that frantic world of the Wall Street casino.
Hey, what's up, guys? Welcome to VIP Financial Education YouTube channel, where we help you go further, faster financially. I'm your host today, Michael Matthey. Guys, we've got a super exciting episode for you today. We've got a great guest. For those of you that are new to the channel, it's a great first video for you guys to check out. We've got a jack of all trades and actually the master of most of them. Those of you that have been on the channel for a while, you're going to be excited to see his face back on here. We're going to be welcoming MC Laubscher on the channel again today. He's been on here previously. We'll go ahead and drop that playlist below. MC is just a wealth of knowledge. He's the founder of Producers Wealth. He is the creator of the Cashflow Ninja podcast, and he's the author of the book, The 21 Best Cashflow Niches, which I've personally read and we've reviewed on this channel here before. So welcome, MC. Thanks for joining us again. I know you're a busy guy.
Thank you so much for having me. I've been looking forward to our conversation.
Yeah, likewise. Obviously, we were talking offline before we got started here. 2023 is just off to an absolute bang for both of our businesses as well, personally and professionally. We brought you on here today to talk about something super specific, and it could not be more of a relevant time. We've had you on here in the past talking about the whole life insurance policies and specifically the infinite banking concept. That's why we've got you here today. It could not be more relevant. I'm going to ask you why. So go ahead and answer that question for our audience. Why is now the best time, with the volatility of just the global economic markets right now, volatility with different investment classes, why is now the best time in recent history to really take a look at the whole life and utilizing that IBC concept to really scale up and level up your investment classes?
Yeah, when you are crafting an investment strategy, I keep things very, very simple. I try to simplify until it almost hurts. So there's 4 key areas really where I allocate capital. The first area is cash. The second area is metals, which is your gold and your silver, just because gold's been money for, centuries, really, right? And it's sort of your wealth insurance. And then there's your cash flow portfolio. And then you also have a 4th allocation for growth opportunities. And this might be a little bit more speculative, right? So you've got cash, you've got gold and silver, you've got your cash flow portfolio, and then you have your growth bucket. So let's get back to cash. Everybody knows that, especially in an environment where there's a lot of deflationary pressures, cash is great to hold. Why? Because when prices come down of assets, you can buy assets at a discount. And also, when you need to fund your business or save other investments that you own, you have access to cash. Now, the big question becomes, where do you position cash? Where do you keep cash? And what we've been sharing is, one of the best places to keep cash is inside of life insurance, and more specifically, a very specific designed life insurance policy, which is a dividend-paying whole life insurance policy with a mutual insurance company designed for high cash value from day one. This is a great vehicle to position cash in, because the companies have been around since the mid 1800s. They've gone through depressions, market crashes, recessions. they've gone through monetary resets. Monetary resets is a big topic that a lot of people are talking about in the investment world. Well, these mutual insurance companies have lived through several of these monetary resets. It's also essentially out of the Wall Street casino, because it's a mutual insurance company. These companies are not listed on the stock exchanges, and they don't have to participate in that frantic world of the Wall Street casino. They can manage the company on behalf of the shareholders, which are the policyholders, and make decisions which are in the best interests of these policyholders. So when you look at how companies or organizations or financial institutions will behave in the future, well, you just look at how they've behaved in the past. And these companies, more specifically these mutual insurance companies, have really stood the test of time. So from a counterparty risk standpoint, this is a place where people can, of course, look into positioning capital. And then the product itself, this specifically designed life insurance policy, and as I've mentioned, it's a dividend-paying whole life insurance policy with a mutual insurance company. This will do when you want it to do it, even though if you're not around, to see the result. So this should be a rock solid foundation within your strategy. It's just one of many things, right? It's just a tool. And this is the tool that provides that certainty in a world of uncertainty. You have your capital inside of a institution, a mutual insurance company with a very, very good track record of almost 200 years. That's going to give you guarantees. It's going to give you tax-free growth, and you're going to be able to participate in dividends. So, and when you need it, you could get access to this capital as soon as 48 to 72 hours, because that's the other question that people had too. How quickly can I get to it? What are other areas? If you compare it to other areas, would you keep capital in banks in a time where I would argue that, it's probably very risky to be overexposed with capital in the bank. We just had a board member of the FDIC in an online meeting literally say that there could potentially be bail-ins. And this is the institution or the entity that insures deposits of depositors in banks for up to $250,000. And they're telling you that there will be bail-ins. Why? Well, that means
that's not a massive vote of confidence there.
No, it's not. So they know that they know that there's a lot of risk in the banking system. I see a lot of risk in the banking system. So people say, well, where else do I keep my capital? And this is where infinite banking comes in. This is where these mutual life insurance carriers come in. And this is where the strategy, which is just part of your overall strategy, comes in. It's the certain part of your strategy in a very, very uncertain environment.
A couple quick points that you made there that I want to touch on again. I love the fact, a couple of the nuances of this product that I really do appreciate is the fact that it's not beholden to Wall Street. If you could kind of do a tie down on that, MC, just so people, that really needs to hit home with folks so that you're not beholden to Wall Street with these types of policies. They have been around for hundreds of years, so they've seen the good, the bad, and the ugly. They have withstood the test of time, so they are tried and true. This is not speculation, guys. Again, the guarantees, the tax-free growth, the dividends, and the easy access. Those, if I'm a consumer and I'm looking to get into an investment product, investment vehicle like this, those are going to be the high points that are going to catch my attention.
Yeah, absolutely. And yeah, when it comes to life insurance carriers, there are stock life insurance carriers, and then there's mutual life insurance carriers. Now, stock life insurance carriers, these are stock companies. They're listed on the New York Stock Exchange, a lot of them. And what they're beholden to is the shareholders of the stock, people that buy their shares on the equity market. So they have to be very, very aggressive with investments that they make, because they have to, report these quarterly earnings to everybody on Wall Street and show everybody that this is a company of that stock of which people should own, right? So they do things that could be a lot more riskier than what they should be doing. Everybody remembers 2008 and 2009 where AIG was bailed out. That's a stock life insurance company, and they were involved in a very, very risky operation with investment banks. Now, on the other side, you have mutual insurance companies. They're not listed on the stock exchange. They're not beholden to Wall Street. The primary responsibility of mutual insurance companies is to manage the company in the best interest of the shareholders, which are the policyholders. So that's why they've been around since the mid-1800s. One of these carriers have paid dividends, which is a sort of profit sharing, out to their policyholders every single year since 1847. Now, if you and I put our minds together and we try to just come up with a couple of companies that have been listed on the New York Stock Exchange for over 100 years and have been profitable every single year for 100 years, we'll scratch our heads to come up with a list.
We don't need many fingers for that, I wouldn't imagine. No.
Yeah. So they've stood the test of time. And the reason why is because they have a very long-term vision and view. They don't have to make sudden movements. They don't have to react to market moves. They're very, very conservative. And the capital that's in these policies too provides a stabilizing factor in an investor's portfolio. Stabilizing factor in the manner that when markets go down, and there's panic in Wall Street, that doesn't affect the policyholder because the capital is still in your policy. You know, yours was a great litmus test. Everybody remembers the events of March 2020. Who's ever going to forget that? And it's almost a 3-year anniversary here, right? March 2020 was a shock, if you can call it, to the system. Everybody around the world was shocked because they couldn't believe what was happening. The financial markets were panicking. Everybody was panicking. I mean, fear, the panic, the hysteria was everywhere. So what happened to these mutual insurance companies? What happened to the policyholders and the capital in these life insurance contracts? Nothing. At that point, and I can speak from my own experience, I had to take out a policy loan because I was actually looking to invest some money in my company at that stage for a specific project, unbeknownst to the events that was coming, right? But even though during that time of mass chaos, I was able to access my capital within 48 to 72 hours, the account balance did not move or shake. And this was at a time where the financial markets were in panic, right? They were down 40, 50% at that point, some people in their portfolios. So that's what I mean about certainty in an uncertain world. When you literally have a global pandemic unfolding, the entire world's being locked down. Companies are being moved from their offices to virtual offices in their own residences. And nothing, shook these mutual insurance carriers during that time.
No, I love that. Guys, if you're watching and you're already at least interested in getting some more information from MC and his team of experts about whole life and ultimately implementing the infinite banking concept into your investment portfolio strategy, go ahead and email ninja@vipfinancialeducation.com. We'll drop that email below. Be sure to include your first, your last name, and the best phone number to reach you in the body of the email, and include Cashflow Ninja conversation in the subject line, and someone from MC and his team will get back in touch with you ASAP, guys. What does that look like, MC? So you have that initial consultation with them. How do you find out if it's a good fit for someone versus a bad fit for someone? Also, are there age restrictions on that? If you can kind of get to, maybe a little bit of a whole life policy 101 for those that have not seen the videos in the past. And of course, guys, we'll go ahead and drop the playlist below to previous videos with MC, but who shouldn't reach out right now? How do you know without even talking to someone if there may not be a good fit? And who should reach out? At what age should people start investing in these types of policies? Is there an age where it's too late to start?
Yeah, I would say if you're making $100,000 a year and you can allocate $10,000 to the specific strategy, it's going to make sense for you. And on the initial call, we're just going to go over your goals and look at what you're already doing and see if there's certain inefficiencies and ways that we can make those inefficiencies become obviously more efficient. So, and from a strategy standpoint, we have a lot of clients that are very, very young. they are in their early 20s. They are starting to make good money, but they have a lot of time. Then we have folks on the other end of the spectrum. Let's just say they're in their late 50s, early 60s, maybe almost in their late 60s. They don't have a lot of time, but they have a lot of capital and they have a lot of resources. There's a strategy for them of how we could fund these policies and have them quickly funded and paid up within 5 years. And the funds that go into that strategy, for example, will be able to help them establish a tax-free retirement. And then there's folks in the middle, folks in their 30s and their 40s and their 50s, they're making good money, and they are I mean, they've still got some time left too. There's some different strategies for them as well. So there's a lot of different strategies. I mean, we also have strategies where you essentially set up a family bank. So it's for the parents and for the children. And we could also share on the call very creative ways how parents, especially if there are business owners and investors, can fund these policies for their children. So there's a lot of different strategies. I always, kind of refer to this vehicle as a Swiss Army knife of financial just products, because there's so many things that you can do with it and so many things that it can help you accomplish. But the biggest thing is you want a place where your capital is, where you know that you can access it. You want it to grow guaranteed. You want it to grow tax-free. One of the things that we talk about, especially in 2023, is one of the worst strategies from a wealth strategy standpoint is tax deferral. If you have in your strategy right now that the majority of your capital is being tax deferred, you definitely want to take a look at that. So within these policies, you're not deferring taxes, you're paying taxes on the seed, then funding the policies and not paying taxes on the harvest later. And then, of course, for folks that are going into their retirement years, we have some great income strategies where you can fund these policies quickly up in 5 years. And by the way, if you're over 59 and a half years old, you definitely want to explore this. You could fund it within 5 years, and this will create some certainty for retirement for you, because you can set up a tax-free retirement using this vehicle.
Yeah, I love the fact that it's not a one-size-fits-all approach, because there's no two of the same person. There's no two people have the same investment goals, obviously the same amount of capital coming in, the same desired outcome. I love the term Swiss Army knife. Guys, it could not be more important right now to have investment tools, vehicles, and resources at your disposal that have the ability to pivot based on market conditions, and that's that Swiss Army knife approach. Good market, bad market, anything in between, you've got the ability to use that resource and just make small tweaks to it. So, we've got a lot of folks on our channel right now that have heavy interest in either getting involved in or are actively involved in real estate investing. If you could kind of give an example for those folks on how this would be a great vehicle for them to utilize, a great application for them to expand their real estate portfolio, for example. They get a policy with you. What does that process look like? And then how do they turn that around and invest in real estate by taking advantage of that IBC?
Yeah, you can set these policies up with a minimum and a maximum. So you'll have a minimum amount and a maximum amount every year. And that's very flexible. And this is very important, by the way, especially for business owners and investors. You want flexibility in the payment of premiums, because we all know as business owners and investors, especially real estate investors, is feast or famine when it comes to liquidity, right? Sometimes we have so much liquidity, we don't know what to do with it. And other times there's a ton of deals out there. We just deployed a ton of capital and we're a little bit squeezed on it. So you want flexibility in funding it. So we'll make sure that that's in it. Then you want the policy structured, obviously, for maximum cash value day one. And within 30 days, you'll be able to set up a credit line using the cash value in the life insurance policy. So within 30 days after setting this up, and a whole process, from our initial call to getting the policy approved could take about 2 weeks. So 2 weeks, then 30 days, and you'll be able to access the cash value in the policy through a line of credit. Then when you find an opportunity and you want to access the capital, you use your credit line, just like you use a HELOC to then access the capital and fund the deal. And then you repay yourself. And this is the other thing, is through some of the credit line strategies that we have, there's a lot of flexible payments in paying back your credit line. You are literally your own banker. It's very flexible on the front end when you're making deposits into your quote unquote own bank. So you want a lot of flexibility. You want the capital in there and the principal guaranteed. You've got guaranteed growth, and it's growing tax-free, and you'll get dividends. And while this is happening, you establish a credit line using the cash value. So you never touch the cash value. The cash value is growing, even though you're using a credit line to access capital through the credit line. And to then invest in real estate deals. So, and on the back end, it's very flexible with repayment. So, yeah, this infinite flow of capital through your personal business and investing economy continues, and you have full control over that. I cannot stress how important control is in 2023. Control is huge. Having certainty, knowing that you'll be able to access capital. Some of the viewers of this channel might have been around in 2008 and 2009. I sure was, as a real estate investor, and know how hard it was to get hold of capital. We've had a great run, right? We've had a fantastic run. Since I would argue around 2012 up until 2022, it's been a great run. There's still going to be a ton of opportunities, but it's going to be much more difficult. And just know that liquidity is and capital is not going to be that easy to come by like it used to. So you want to position capital where you can get it and capitalize on opportunities. That was one of the biggest lessons I learned, by the way, from 2008, 2009, is there were deals all around. I mean, they were just everywhere. And yet I couldn't move on them because I didn't have access to the capital that I wanted because I wasn't prepared. So this time, that's why I added personally eating my own cooking without throwing up, as I like to say. That's why I added another one of these policies.
I'm stealing that from you.
Yeah, I added another one of these policies in December of last year because I want to be prepared the next time when assets are on discount. I don't want to be in a position where I don't have access to capital. So I think it's a great vehicle to position capital, to be able to access it. A lot of folks that will solely rely on HELOCs, I can share, a lesson from pain that they can go away at any moment in time. Banking and financial institutions can decide to just discontinue the product or just pull it. Yeah. So you want access to capital when there's deals. You don't want to be sitting around and just looking at people capitalizing on those deals. And, one of the other things that I also learned was there's a ton of hard money lenders out there, right? And real estate investors love hard money lenders. I love them too. And there's a ton of private lending. But guess what? When the deals are so good, they'll buy them themselves, right? They're not just going to give you the capital to go buy them. They have the capital at that stage. They'll capitalize on those opportunities. So also do build good relationships with hard money lenders and private lenders, but don't depend on them solely. Put yourself in a position where you have a lot of options when there are deals around.
Yeah, I love that. So be prepared, without needing the assistance of someone else, which is why setting up this policy is critical, really, so you can control your own investment destiny, but also have those resources. I've always got hard money and private money people in my camp. So, if I don't have access to my own capital at that point, I can obviously get cash from them on whatever terms those happen to be. But I always want to have, obviously, a lot of my own capital under my own control so I can go out there and make those moves without needing anyone else's assistance on that, or OPM, if you will. You mentioned that you just picked up a new policy, and just on a personal note, you actually just recently set up a policy for my sister, and she's amazed at the flexibility of it. She is just now getting into real estate investing with my encouragement over the last, it only took me like 10 years to get her interested in being in real estate. She's got that policy, and now she's making moves, and she's sharp, and this is still kind of blowing her away on how this works. So I appreciate that on a personal level. You set up another one for yourself. Obviously, this is something you've been doing for a long time. Why a new policy for that?
Yeah, again, I was going through my strategy and then looking at my 4 buckets. Like I said, I like to keep it simple. So I looked at cash, I looked at metals, and then I looked at cash flow portfolio and growth areas. And, in a world where there's so much uncertainty, cash is great to have. And it's kind of comical because, a lot of us in the investment world, we've talked about, and I've said all of these things. I've said cash is trash. I've said, cash deep values, you got to keep it moving. I said all these things, but you know what? When you do have cash and access to cash, opportunities will seek you. So, I looked at it and just studying also what a lot of players are doing. A lot of people are moving into cash, the Warren Buffetts of the world, the Ray Dalios, all of them. So I kind of like just research and look at what folks are doing. And I decided, to look at another cash position. And again, the problem that is solving is, where would you put it?
Right.
And I feel like the banking system is very fragile. And I feel like there's something brewing inside of the banking system. So I didn't trust the banking system, and I looked at mutual insurance companies. So that's why I personally looked at that. And like I said, I ate my own cooking without throwing up. So I can't find another better place for it. So that's what I personally did.
Yeah, I love that. And guys, anyone that practices what they preach obviously gets some extra credit in my book. So thanks for joining us, MC. Guys, it's a critical time to really capitalize on the market as it stands today. People that made all that money, myself included, post 08, took advantage of opportunities like this. They had investment vehicles like whole life policies and utilizing the infinite banking concept. Do yourself a favor. If you're at least curious, or you want to move forward, or at least get some more information, go ahead and email ninja@vipfinancialeducation.com. That will go directly to MC and his team of experts. They'll reach out to you. So be sure to include your first, your last name, the best number to reach you in the body of the email, and Cashflow Ninja conversation in the subject line, and they'll get back in touch with you ASAP to see if you're a good fit. If you are, obviously talking about next steps. So thanks as always for joining us here, MC. We'll love to have you back on here later in the year just to get updates. Obviously, we'll continue to give you good positive feedback from our folks that have gone down the path and have signed up for policies with you. And we're getting time and time again just great positive feedback. So folks, if you're interested, go ahead and reach out. Be sure to do your own due diligence as always. Thanks for joining us here. If you're not a subscriber, go ahead and subscribe, ding that bell notification below, and keep on cash flowing. We'll see you on the next video. Take care.